Once you're 5 years out from retirement, you should start thinking pretty seriously about the changes that need to be made to be as prepared as possible for your upcoming retirement. That's why in today's video, I'm going to walk you through a case study that shows you 5 specific changes you need to make in the order in which you should make them so that you can go into retirement as prepared and as confident as possible. Now those steps, and it's very important that you do them in this order, are number 1, dial in your retirement expenses. I'll show you exactly how you can do this in a very simple way. Number 2, determine your Social Security strategy. Number 3, make the necessary adjustments to your portfolio. Number 4, identify any possible tax strategies. And then number 5, recalibrate your plan. So those are the 5 things that you need to do. But what I want to do to start is I want to show you what happens if you don't do these things or don't do them in this order. And then on the flip side, show you what the positive impact is of doing these things and specifically doing them in this order. So let's jump into Jenny's plan, and we're going to use her as a case study to illustrate what this can look like for you. So I'm going to spend the next couple minutes going over Jenny's plan, making no particular changes, and then we're going to go back to the beginning to show what would this look like instead had Jenny walk through the 5 steps that we're going to talk about. So here's Jenny. Jenny is 60 years old today, and you can see a snapshot of what she has in assets today. She has a little bit of money in savings. She has her investment accounts, $480,000 in a 401k, $76,000 in her Roth IRA, $146,000 in an individual account. She owns her home. Her home is worth $765,000, and she has $51,000 remaining on her mortgage. Her monthly payment, and I'm going to come back to this later, this is important, her monthly payment, principal and interest portion, is $1,000 per month. So this is a snapshot of where Jenny is today. Again, she's 60 years old, and her goal is to be able to retire at the age of 65, as you can see right here. When Jenny retires, she wants to be able to spend $6,000 per month. Where does that number come from? Well, if you look at her income today, she's making $8,500 per month, or $102,000 per year today, and after taxes, after deductions, what she actually receives in her bank account is this $6,000. Now this $6,000 today allows her to do everything that she wants to do. She can travel, she can pay her mortgage, she can pay her basic living expenses, and so when Jenny looks at retirement, she thinks she doesn't want retirement to look too different than today, except for the fact, of course, that she'll have more freedom to do what she wants to do, but she says, you know what, if I could just maintain lifestyle today and the expenses today, I'd probably have a pretty good retirement. So that's what she's starting with. We looked at her income. Here's her Social Security benefit. If she collects at age 65, she would receive $2,400 per month at the age of 65. In between now and 65, so 60 today until 65, Jenny is saving 8% to her 401k. She receives a 3% employer match. She's also saving $6,000 per year to her Roth IRA. So those are the details of Jenny's strategy. How old she is, the current assets that she has, the savings rate that she has between now and retirement, and what retirement's going to cost. Let's skip over right to the retirement tab for Jenny. What we can see is here's her portfolio balance today, the $700,000 or so. That's going to continue growing for the next 5 years, and then she retires and she starts to spend down her assets, and she is fully run out of money by age 85. And if we look at her probability of success, not super high. 24% probability of success that her assets will last until the age of 90, which is how we're defining success in this case. So Jenny sees this, and it's very clear to her, at least in her mind, that she needs to work longer. So she looks at this and says, okay, well, what can I do? If this was retiring at 65, what if I retire at 68 instead? How far would that get me? Well, we refresh Jenny's plan. Now keep in mind, we have not gone through the 5 specific changes yet that are going to be dramatically different when we show Jenny what that plan looks like. But she just starts walking through this on her own. And if she works 3 more years, that's great. But her probability of success, still only 50%. And if Jenny wants this to be anywhere above 60, not that 60 is a magic number, but just using that as a benchmark here, Jenny would have to work until the age of 70. That would push her probability of success to 64%, and her plan would look a lot better. Well, on paper, that's great, or on the screen, that's great, but in reality, it's not great. Jenny's 60. She wants to be done at 65. She doesn't want to spend ages 65 to 70 working when she could be doing other things that she loves doing at that point. So this is why we're going to walk through the 5 steps that I mentioned. If Jenny didn't do any of this, she would have to work another 5 years in order to make her plan work. But let's look at what happens when you approach retirement planning in the right order and from the right perspective. So to illustrate this, let's go back and reset this and start from where we were. So here's that base case again. Here's where Jenny gets to if she does her plan like we talked about. If you recall though, the first step in anyone's retirement process, the most important step, is to dial in what your retirement expenses will be. Now, Jenny was half right here, but she was also half wrong when she was determining her expenses. We looked at $6,000 per month because that's what Jenny is spending today. Here's what Jenny didn't take into account though. She looked at today's expenses and simply extrapolated that into retirement. But if you recall, Jenny is paying $1,000 per month to her mortgage, and her mortgage is expected to be paid off in about 4.5 years. So right off the bat, we can say, Jenny, your actual expenses aren't $6,000 per month, they're actually $5,000 per month if we just remove the mortgage. Now, a second thing we looked at was this $6,000 per month allows Jenny today to take the trips that she wants to take, to do the travel that she wants to do. Now, she doesn't do any really incredibly fancy traveling. She just likes to be able to spend money to go to the places she wants to go, to visit family, to visit friends, to be the places she wants to be. That's about $1,000 per month for her, or $12,000 per year. In reality, Jenny's not going to be doing that forever. So to be putting that as her core monthly expenses means that that's something that Jenny is going to spend until age 90. If we look at this a bit differently though, probably look at this more realistically, we could say, Jenny, how long do you actually think that you'll be traveling like that in retirement? And she might say something like 10 years, which is why if you look here, we're saying, what if we define your travel goal as starting the year that you retire and going or lasting for 10 years? So if we did that, and if we added the $1,000 per month here, what this is doing is it's not including this $1,000, this extra $1,000 per month forever. It's simply including it from age 65 to 75, because from ages 75 and beyond, Jenny's probably not traveling so much. So what we've done here is we've simply dialed in her expenses to a more realistic version of what they will actually be. It's still $6,000 per month today, but once that mortgage is paid off, once we properly account for travel, we can start to see that running the same exact projections is going to have a dramatically different result. Now, as you're watching this, if you want to follow along, if you want access to the same exact software, you can actually get access in the Retirement Planning Academy link below. The Retirement Planning Academy walks you through a video module of how to approach retirement planning, as well as gives you access to the software here. So right off the bat, we can see how important it was that Jenny gets those expenses correct. This might seem so blatantly obvious, but I can't tell you how many people I've spoken with that simply look at expenses today and plan on that throughout retirement, the implication being their retirement projections are wildly off. So that's the first thing that everyone should do, is dial in what your actual retirement expenses will be. The second thing that you need to do is you need to determine the right Social Security strategy. The reason we're doing this in this order is your expenses is where we need to start to say, how do we maintain this level of spending so you can live the retirement you want to live? The second part determines how do we maximize your income to best support those expenses. Well, we went through a process with Jenny. Jenny's in good health. She has longevity in her family. She doesn't have a spouse, so we don't have to worry about spousal strategies or survivorship strategies. But what we do need to do is we need to understand how can we maximize potential retirement income for Jenny, and how can we minimize risk. In doing this, we looked at for Jenny the fact that age 70 would be most appropriate for her. So if instead of collecting at age 65 like she was originally planning to do, because that's when she was going to retire, if she would instead collect at age 70, this number is going to go up even a little bit more. Now, that's not always the case. Depending on how you're invested, depending upon other income sources, depending upon your withdrawal strategies, sometimes it doesn't make sense to do that. This is why it's important to have a strategy that's unique to you, but in Jenny's specific case, it did. And what we can start to see is all of a sudden, her probability of success went from 24% all the way up to 86% just through those two simple changes. She's not having to work longer, she's not having to save more, she's just better reflecting reality in her financial planning projections. The third step, once you have done this, is to make the necessary portfolio adjustments. Now, it is critical that you do this in this order. If you start with your portfolio, you're going to miss it, and I'll show you why. What we're looking at here is Jenny's cash flows. Cash flows being how much is coming in from Social Security every single year, starting the year of retirement and beyond, and comparing that to what will Jenny's expenses be. This is the base plan when all we did was assume $6,000 per month, which is $72,000 per year, which if we adjust that for inflation for 3 years is $83,468. When we look at this, what we're solving for is to say how much does Jenny need to pull out of her portfolio every single year to ensure that between Social Security and portfolio withdrawals, she has enough to live on. Once again, you can get access to the same software via the Retirement Planning Academy if you are interested. Link to that is in the notes below. So here is what that looks like in terms of net flows with the base case plan. But what happens if we change this to what we're calling proposed plan? Proposed plan simply meaning the new plan, where we adjusted expenses down from $6,000 to $4,000 per month because the mortgage would be paid off, and we're accounting for travel separately, and we're also pushing Social Security out until age 70. What does that do? We'll look at this number here, and let's look at what's going to change. So prior to making the adjustment I just made, this was showing current plan. Now we're looking at proposed plan. This was about $54,000. Now it's $70,000. Why did the withdrawal from Jenny's portfolio go up when we actually adjusted her spending down? Well, this withdrawal went up because we pushed Social Security out. And by pushing Social Security out, it means there's more pressure on Jenny's portfolio today to support all of her income needs. Let's look at the actual implications of that. If we go here, we can actually turn this into a withdrawal rate or calculate a withdrawal rate. So here's what that looks like. Year one, Jenny's taking 6.8% out of her portfolio. By age 69, she's taken almost 10% per year out of her retirement portfolio. If you were just to look at those numbers, this would be a wildly unsustainable withdrawal rate. You would look at this and say there's no chance this can last all of retirement. But if you only look at the first 5 years, you're missing the big picture. In Jenny's case, she's taken a lot more of those first 5 years because she's traveling more for the first several years and because Social Security has been pushed back. Once Social Security kicks in, now you can see that her withdrawal rate drops to about 4% per year. Once she stops traveling as much, her withdrawal rate decreases to 3% per year. So what you can start to see is something that might seem wildly unsustainable. If you zoom out enough, and if you're doing planning the right way, you can start to see that this might be doable, but you have to make the right portfolio adjustments. What are those portfolio adjustments? Well, you need to ensure that whatever amount is required in those first few years, pretty significant amounts of the portfolio, do you have enough money set aside in something that's really conservative, really stable, something that's not going to be wiped out if and when the market drops 30, 40+%? Because if all of Jenny's money was invested in growth-oriented investments and there was a downturn in the market and those growth-oriented investments suffered a tremendous decline, there's no chance you can take out between 7 and 10% for 5 years from a portfolio base that's been depleted. So this is why Jenny would need to start shifting more of her portfolio, at least for the first 5 years, into conservative assets. Once she got here, and especially once she got here, there's not that same need. Even though she's getting older in traditional thinking, says the older you get, the more conservative you should be, as she gets older, there's less and less of a need from her portfolio, which means there's less and less of a need for conservative, stable assets. So this is why it's so important to do the portfolio allocation after dialing in your expenses, after finding the right Social Security strategy, because now we can see what role the portfolio plays and you can start to make strategic decisions around that. The fourth step as you prepare to retire is to identify the most impactful tax strategies. I've already gone ahead and done the analysis in this case for Jenny because we don't have time in this video to fully explore this. But what Jenny is going to do is, because she pushed Social Security back until age 70, she's going to convert bits of her IRA into a Roth IRA just enough to fill up a 12% tax bracket. That's what we're looking at right here. And she's going to do that from age 65 until 70. Why only until age 70? Well, age 70, Social Security kicks in, and so she's going to have a tax planning window between 65 and 70 where her income is lower. When her income is lower, we're going to take advantage of that by shifting some of her IRA into her Roth IRA, and again, just enough to fill up this 12% tax bracket. When we do this, here's what that impact looks like. She has $52,000 more in tax-adjusted ending assets. She pays $44,000 fewer dollars in taxes over the course of her retirement, and she ends up taking $74,000 less in withdrawals from her tax-deferred accounts. So if we take this information and we go back to where we started, of how do we start to optimize Jenny's plan here? We've already dialed in her retirement expenses. We've identified the right Social Security strategy. We saw how we need to allocate different assets to support the strategy. And finally, what we want to do is we want to dial in the tax strategy to say, how can we make this even more impactful by having the right tax strategy? And all of that is going to go into this. So that's step 4. And what we can start to do here is we can see that Jenny's probability of success, her odds of being able to do what she wants to do, have jumped from 24% to 85%. And that's not because she made any major life changes. It's simply because she's doing financial planning right. She's making the right assumptions as to what retirement is going to look like. Now, this is where step 5 comes into play, and this is the fun part. Jenny went from a 24% probability of success to an 85% probability of success. As we look at her comparison here, she's on track to have over $1.6 million more in her plan as a result of these changes. Now, you could make the argument That while Jenny would have had this anyway, she was just planning the wrong way. And you're exactly right. We haven't actually changed anything about reality. We've just changed the way in which we're planning for that reality. But here's the thing. If Jenny hadn't done this, it would have been even more costly than $1.6 million. It would have been costly to the extent that she would have missed out on the 5 best years of her life potentially, from ages 65 to 70, when she had her energy, her health, the means to do what she wanted to do. She may have wasted those or squandered that partially because she continued working, because she was wrongly planning for retirement, thinking that she had to work much longer until she could actually do some of these things. Now what Jenny gets to do is she gets to recalibrate. She gets to say, you know what, I'm in a wonderful position here. And one of the things that Jenny was actually thinking about is at some point, Jenny would probably move in with her daughter once she started to get older. They talked about doing that around age 85. Of course, anything could happen. But if she were to sell her home and do that, well, she has even more money than we're talking about here. So what does that mean? Well, could Jenny travel more? Could she start to double what her travel budget looks like? Instead of $1,000 per month, it's $2,000 per month or $24,000 per year. She could start to look at those different things and say, yes, that's going to make an impact here, but I'm still in a wonderful position to be able to afford that, to be able to do that, to be able to enjoy my life and still make sure that I'm on track to prepare for what retirement has to come. So this speaks to the importance of having a well dialed in retirement strategy. Start by dialing in your expenses. From there, make sure that you determine the right Social Security strategy for you. Then you can take a look at your investments to say, how should we allocate the different investment accounts we have to best support the income needs that we have? From there, look at tax strategies. Are there things that you can do that can be additive to your plan? And then finally, recalibrate. Once you see what that looks like, how can you optimize this? How can you do more? How can you do more, yes, from a financial standpoint, but more importantly, from a life standpoint, to get the most out of life with your money, using financial planning as a tool to help get you there. Root Financial has not provided any compensation for and does not influence the content of any testimonials and endorsements shown. Any testimonials and endorsements shown have been invited, have been shared with each individual's permission, and are not necessarily representative of the experience of other clients. To our knowledge, no other conflicts of interest exist regarding these testimonials and endorsements. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.